Let's get a bit more on this now. Larry Shover, Chief Investment Officer at SFG Alternatives, joins us now. Larry, let's just start with Japan. Those latest GDP figures showing growth did accelerate in the first quarter. Asian markets certainly reacted well to that news yesterday. We saw the Shanghai Composite in China jump 1.2%. Does this mean the Bank of Japan's stimulus measures are actually working?
You know, I think short term they are working, and the proof is in the pudding with the Nikkei up 45%. Also, yen down about 27% on the year against the greenback. However, we have to think intermediate and long term. I mean, what's it going to do to exports for China, for Korea, et cetera? And people are worried about a looming currency war. So, yeah, I mean, it's great for now, but will it last? And I think, at least in the U.S., we're very skeptical that this kind of pace will continue to last without some type of reprieve from the other countries in Asia.
These are really baby steps for Japan, though, aren't they? I mean, it's unlikely, isn't it, that we're going to see any surprise policy changes from the Bank of Japan when it meets next week on May 21?
No, I mean, there might be some changes. And actually, from America, I think the whole market here is on hold. I mean, given the volatility of the JGB, the 10-year yield, which has basically doubled since April. I mean, people are really worried about what's going on in Japan. So people are factoring in that perhaps there will be some type of surprise coming, especially when you look at the volatility in their bond market.
Also on that date, May 21-22, we've got Fed Reserve Chairman Ben Bernanke updating Congress on the central bank's economic outlook. Are we likely to get any indication from him on how and when the central bank may begin winding down its $85 billion a month bond buying program?
You know, I don't think we're going to get exact granular detail on how or when. I think it might be more of the same, and I think the stock market in the U.S. is reacting that way because today in the U.S. we had 3 numbers come out. Two out of 3 of those numbers were not good, but yet the stock market really didn't care a whole lot. I think we're all expecting perhaps tapering to take place at the end of the year. Maybe not no matter what, but if we continue on the trajectory. So I don't think the U.S. market is putting a whole lot of credence on Bernanke doing something game-changing on the 21st or 22nd.
Out of that data, though, did you take the inflation and jobless claims figures as being perhaps the most important in terms of the impact on the Fed's QE3 strategy?
Yeah, I mean, you're exactly correct. I mean, the inflation scenario is something that is of biggest concern to everybody. And today in the U.S., our April CPI number came in less than expected, saying that there's less inflation than people expected. Perhaps that's a good thing, but we're in the middle of a worldwide policy where everybody's printing money. And as this goes, I mean, inflation could rear its ugly head at any moment and could just take off. And that would change things quickly and severely.
Before we let you go, Larry, obviously, even despite that weaker than expected economic news out of the US, we haven't seen gold recovering at all. It seems to have certainly lost its safe haven appeal and now enduring its longest losing streak since March 2009, I think. It's below that 1400 support level. Where do you see it trading from here?
Well, I do believe we're going to see more downside just because of momentum, nothing to do with fundamentals or anything like that. People are scared and they're just getting rid of their gold portfolios. That said, the supply demand's not balanced. We need to see more demand coming out of India for jewelry. We have not seen that. But to answer your question, 1300, 1325 is a very, very good support level for gold, and it's something that everybody should have in their portfolio. You know, the problem is all of us have gotten used to everything going up in one direction since the beginning of quantitative easing. That said, we have no idea how this is all going to end up. And yeah, gold is down a lot right now. However, it's down to the point where it makes sense to put it back into your portfolio if you haven't done so already.